welcome to the 2016 Annual Halftime Report. I'm Chad Stayskull, President of Eagle Wealth Management. We're very happy to have you join us today, and we look forward to sharing some of the perspectives of today's markets. So, to start off, we have to do a few disclosures. I just want to draw your attention so we can keep those regulators and attorneys happy. Now, I want to really point out, nothing we talk about here today should be considered investment advice. Everyone's situation is different, and we only give advice to clients we know well in one-on-one meetings. I'd like to start off the presentation to discuss our commitment to you as your financial advisor. We spend so much time in meetings discussing the things we can control, like taxes and retirement planning. What happens in the markets and government decisions are out of our control, but the time we spend giving you some education on the media hot points hopefully helps to keep you calm, allowing you to make decisions based on your plan and not emotional reactions. So we put together what we feel are some of the key issues we were discussing midway through 2016. It's hard to believe we're more than half a year already into 2016. All told, it's been very volatile first half with plenty of market headwinds we need to address. I'm sure all of you have questions about what might be in store for the second half of 2016 as well. Our goal is to educate you about some of the factors we in the world's market strategists are watching. While it would be impossible for us to cover every factor that affects markets, we're going to try and touch on what we think is most relevant. While past performance provides no guarantee of future results, we can use some of this information to help guide our decision-making process when investing. So here's what we're going to talk about today. We're going to first cover a brief review of the first half. Then we're going to cover 5 factors that we're watching in 2016. Fact or fiction. Third, we're going to cover, are we heading for a recession? And lastly, we're going to talk about some of the strategies for today's volatile markets. To get started, here's a snapshot of the S&P 500 performance for the first half of this year. This year got off to a rough start. Fears about the economic slowdown in China, combined with panic over plummeting oil prices. This caused a short but severe pullback. You probably remember that market experienced a correction last August as well. And it wasn't so surprising to see another tumble since many of the same headwinds continued to blow in 2016. Stocks started to regain some steam at the end of February, but then sold off again as investors were starting to breathe again. Markets freaked out over falling oil prices, global growth worries, and fears about an imminent recession. However, after reaching a low in mid-February, stocks experienced some steady growth through May. Then another volatile pattern set in. Jitters about the time of the next interest rate hike by the Fed Reserve contributed to a lot of this volatility. Markets tested new highs in mid-June and then gave back into fear after Britain voted to exit the European Union on June 23rd. Fortunately, investors shook off the nerves pretty quickly and rallied in the final days of the quarter. Will Brexit come back to haunt us in the months to come? We're going to talk about that later. But all told, the S&P 500 gained 2.69% for the first 6 months of the year. This is not stellar performance, but it's pretty respectable considering the headwinds we faced down the start of the year. At the beginning of the year, we compiled the S&P 500 price targets for some of Wall Street's top analysts. I wanted to take time to review those predictions and see how some of them have changed at the halfway mark. We can see that several analysts have lowered their price targets for the year. This indicates they expect the headwinds that we've been experiencing to drag on performance this year. The S&P 500 closed at 2,098 at the end of June. This put it pretty close to the annual target of a couple of analysts. Back at the beginning of the year, the average across all these analysts was 2,193. Accounting for the new revisions, the average price target is now 2,125. This reflects the changes in the expectations for the year. Of course, we're not trying to foretell the future. No one knows for sure what equities will do in the second half of 2016. One thing that appears repeatedly in analyst forecasts is that sector and stock picks matter. Even as the S&P 500 as a whole might decline, it's possible to find individual success stories. That's why we work with all of our clients to develop customized portfolio strategies that help them to pursue success in many of the market environments. With all this turbulence and uncertainty this year, there's a lot of potential threats to watch. However, some of these threats have merit, and while others are just a lot of smoke. Let's take a look at what could be a fact and what might be a fiction for some of the headlines we see in 2016. Fact or fiction? We're out of the woods in Europe. Between Greece's debt worries last year, Britain's vote to exit the European Union, and Europe's general economic woes, Headlines from across the Atlantic have taken up a lot of bandwidth. However, markets shrugged off the Greek debt crisis and Brexit fears. That must mean we're out of the woods, right? We think this is fiction right now. Greece's ongoing debt problems and Brexit are likely to send us more headlines and more volatility through the rest of this year. Now, does that mean Europe's troubles are going to cause a crisis and end our bull market? You know, we can't say for sure, but we don't think that Europe's woes will tip us into a bear market. The chart shows us the effect of a number of historical stock market shocks on the S&P 500. There's a lot of political turmoil in Europe, and that caused plenty of uncertainty over here. This June, the S&P 500 dropped 3.6% in a single day after Britain voted to leave the EU. We don't know yet whether markets are done reacting to this shock or not, and we could see more volatility. However, though we see Europe as a headwind this year, we don't think its problems are enough to cause an end to the bull market. Fact or fiction? The Federal Reserve raising interest rates will spell disaster for markets. We've seen a lot of headlines about this since the Fed hiked interest rates last December. And again, we're going to say fiction. We don't think that further rate hikes will bring about a bear market. We don't know for sure, of course. However, we can look at what's happened in the past for clues. This chart shows how the S&P 500 performed after the second rate hike, averaged across all previous Fed tightening cycles. Historically, the averages show that there's an initial rise, some volatility and consolidating, and then a rally months later. On average, history shows that stocks do pretty well in the months following a second interest rate hike. Now, as always, past performance is no guarantee of the future. There are also averages that don't take into account the unique factors around this tightening cycle. However, a lot of the worries about Fed tightening might come from two historical anomalies. A surprise interest rate increase in 1979 ushered in two back-to-back recessions and high interest rates. Another hike in September of 1987 preceded the Black Monday crash in October of that year. However, the situation this year is different. There aren't any surprises because the Fed has done a good job, and some might say too good, of telegraphing every play in advance. We know exactly what the Fed is thinking because officials tell us every chance they get. They learned their lesson well. However, we can't say for sure that stocks will respond according to historical averages. The past doesn't predict the future. One concern cited by economists is the fact that the Fed is raising rates during what is known as a corporate profit recession. That's a period when corporate profits earning growth is negative. We'll talk more about corporate profits later. Fact or fiction? A recession can't happen. Now, hopefully all of you said fiction on this one. We also think fiction. Recessions are normal parts of the economic cycle. We can't always be in recovery or expansion. It wouldn't be surprising to see a recession in the next few years. The 20 speedometers you see on this slide are visual representations of what we call leading economic indicators. City National Rochdale put these together. They are forward-looking and help us to see what pressures will be acting on the economy and financial markets in the next 3 to 6 months. Green is positive for the economy. We could call a green indicator a tailwind that pushes economic growth along. Yellow is caution, and red is a headwind that acts as a brake on economic growth. This data is from January of this year. You can see that the board is almost completely green, except for 3 yellow cautions from political environment, global growth, and equity market valuations. The one red dial is from geopolitical risk. Let's see what's changed. Here is the latest data from the end of June. You can see that, though most economic indicators are still showing growth, a few things have changed since January. The political environment has shifted into the red from yellow. This is likely because we have concerns about the upcoming elections. Geopolitical risks are still in the red due to concerns about what might happen overseas. And corporate profits, which we talked about prior, is shifted to the yellow caution. We'll discuss some of these risks shortly for you and show you how we're preparing our clients for a possible recession. Fact or fiction? If there's a recession, it will trigger a massive market correction. Well, this one might be another fiction. Recessions aren't always calamities. The recession that began in 2007 was especially bad for markets because of a combination of economic, business, and financial events. However, recessions don't always trigger market catastrophes. This chart shows us periods of a recession as dark bars and severity of the bear markets in the S&P 500 as the light blue bars. A bear market is defined as a sustained period of market decline during which stock prices lose at least 20% of their value. I want to point out a couple of things in this chart. 1. Recessions have occurred without being accompanied by bear markets. We can see several separate occasions when this happened since 1950. Bear markets have also occurred independent of recessions. This is usually because of external market shocks. It seems logical that a recession would trigger a serious bear market. Recessions usually lead to declines in corporate profits, which ought to push stock prices down. However, the link isn't that simple. A lot of factors influence stock prices. Factors such as inflation, interest rate, investor sentiment, and market shocks all influence stock prices. So, if a recession happens, what can we expect from markets? This table shows us the S&P 500 performance before, during, and after an official recession. Take a look at the third column from the left. The first surprise is that, in many cases, the stock market was actually going up during the months that the recession lasted. This tells us that the link between recessions and bear markets isn't tight. Over the 9 recessions on the table, S&P 500 total returns were positive for 4 of them. Part of that reason might be because the stock market is a leading indicator and is always looking forward. That's one of the many reasons why trying to time markets when you think a recession might be coming is a terrible idea. Though the past can't predict the future, we can look at it for hints. Each market and economic cycle is different, making handicapping in advance pretty close to impossible. What we're doing here is making some educated guesses on how markets could be affected by the next recession. So, will the upcoming presidential election process have an effect on markets? Maybe. If you go looking, you're going to find any number of theories about home price cycles, stock market cycles, and even zodiac cycles, all related to the presidential cycle. So fact or fiction? We think this is mostly fiction. While the results of the presidential election might affect your heart rate and peace of mind, the sitting president doesn't really affect markets that much. This chart shows the average annual returns under Republican and Democratic presidential terms between 1961 and 2015. Are you surprised? While the numbers might suggest that a Democrat in the White House is overwhelmingly better for stock prices, this isn't really all that cut and dry. There is no commander-in-chief of financial markets. In fact, the release of a new iPhone by Apple has much greater effect on the overall S&P 500 performance than the president. Why? Apple is the largest company in the S&P 500 by market capitalization, and the iPhone, its most important product. Back in 2014, Apple and sales of the iPhone drove 18% of the S&P 500's performance that year. So what do you think? What do you say? Would you say there's a lot more going on in the stock market than who's in office? I'd say so. Now, I want to point out that though presidents might not directly control markets, they do hold a lot of power in terms of legislation, politics, and getting things done in Washington. Each candidate has a platform, and the decisions the president makes in office could have a big impact on your financial bottom line. However, there is a big difference between what a presidential candidate says during the election and what actually makes it through the legislative process. Markets hate uncertainty, and this year's election might very well cause more volatility. Depending on which party ends up controlling the White House and Congress, a lot could happen. Or, more than likely, not happen legislatively that could affect certain sectors in overall markets. We, and the world's analysts, will be closely watching the election to see how the results could affect our clients' portfolios, and we're going to try and keep you informed. Let's move to the next point. A big question on many investors' minds is this: are we heading for a recession? And it's an excellent question. We're in the 7th year of an economic recovery and expansion, and we know that recessions have to come sometime. Could it be this year? Maybe, but it doesn't seem likely. Could it come in the next couple of years? That seems like a much stronger possibility to us. So, in the next few slides, I want to show you some of the evidence for and against a recession, so you can see the same information that we and other strategists are watching. The first point I want to make is that predicting a recession is very, very difficult. Lots of data has to be analyzed, and it's always a backward-looking process. You might have heard of a recession as 2 consecutive negative quarters of GDP growth, but that's not an officially accepted definition. Officially, an economic recession is defined as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So, I'm sure all of you can quantify that fairly easily. Not really. The government scorekeeper for recessions is the National Bureau of Economic Research. And economists there usually don't formally announce a recession until months after the recession actually begins. For example, the Great Recession began in December 2007. It wasn't officially called a recession until December 2008. That's a full year later, and just months before the recession actually ended. The prior recession, it began in March of 2001 and wasn't called until November of that year. That's the same month it officially ended. Why is this? It's because all the data that goes into calculating a GDP growth and other indicators isn't completely available until months later. The National Bureau of Economic Research has to be very sure of the data before it makes that kind of official assessment. So, even if we enter a recession, the official call won't come until months later. That doesn't mean that any expert with a pulse won't try to predict one in advance. And some people think you can predict a recession by looking at the stock market behavior. There's a great quote by Nobel economist Paul Samuelson, and it says, "The stock market has forecast 9 of the last 5 recessions." However, we can look at the same data economists look at and make some educated guesses. So the first thing I want to look at when asking about recessions is this. How long is an expansion supposed to last? The National Bureau of Economic Research has an official data on recessions and expansions going all the way back to 1854. According to the research, since 1945, we've had 11 complete economic cycles, and we're currently in an economic expansion that began in June of 2009. Since 1945, the average expansion has lasted 58.4 months, or just about 5 years. That puts the length of our current expansion well above the average. However, I want to caution you against thinking we're due for a recession. Much like bull markets, economic expansions don't just die of old age. Something has to cause the recession. I also want to put out there that the last 3 economic expansions have also blown past the averages. The expansion that began in November of 1982 and ended in July of 1990 lasted 92 months. The recovery that began in March of 1991 lasted over a decade and ended in March of 2001. The recovery that began in November of 2001 lasted 73 months before ending in December of 2007. Now, we can never use the past to predict the future, but the increased length of those last 3 expansions indicates to us that the economy is growing more stable over time. However, the fact that current economic expansion has lasted longer than the average could be a mark in the pro-recession column. So how long might we have before the next recession hits? That's the trillion-dollar question. One thing history tells us is that recessions often follow interest rate hikes. Now, we don't know that there's a cause and effect relationship because every interest rate tightening cycle is different. However, we can look at past cycles for clues. Here's what we know from data collected by Deutsche Bank. The average tightening cycle lasts 22 months between the first hike and the last rate hike. The average amount of time between the first rate hike and a recession is 41 months. The Federal Reserve first raised interest rates in December. Does this mean we're guaranteed to see a recession sometime in the next 30 months or so? Definitely not. The past doesn't predict the future. There's also some unique factors at play during this cycle that makes forecasting difficult. One, the economic expansion has been unusually moderate and not characterized by standout growth. According to Deutsche Bank report, out of the 118 rate hikes since 1950, only 2 have ever happened with nominal year-over-year gross domestic product growth below 4.5%. And remember, we're currently at only 2.1%. 2, the Fed has trillions of dollars on its balance sheet already that need to be reversed. And they might be reluctant to engage in more quantitative easing if we do see recessionary pressures. 3, we're in a corporate earnings recession, and U.S. companies are already struggling with weak demand. 4, the Fed is moving very cautiously in raising interest rates. They're looking at the same data we are and telling us over and over again they want to be moved cautiously and protect economic growth. Again, I want to emphasize, we're not saying there's a direct relationship between interest rate hikes and recessions. It's a very complex relationship, and each tightening cycle is different. In our current rate tightening cycle, we know that the Fed is anxious to begin raising rates so that they can eventually lower them again if necessary. They need to do this to fight off market shocks, economic problems, and higher inflation. With rates so close to zero, the Fed doesn't have many bullets left in the gun to fight downside risks. Another headwind for the economy is weak state of corporate earnings. We mentioned earlier that the Federal Reserve might be taking a risk raising interest rates while we're in a corporate profit recession. This chart here shows us earnings per share of growth of the S&P 500. This measures how much corporate profits have grown in a given quarter per the share of stock. Starting in the first quarter of 2015, we can see that earnings growth turned negative, meaning the overall S&P 500 companies saw their profits shrink from a year earlier. Quarter 3 and quarter 4 of 2015 were especially rocky for earnings, with the overall S&P 500 earnings down 14.5% and 15.5% respectively. For the second quarter of 2016, overall S&P earnings are forecast to be down 5.3% from a year earlier. If earnings are down, it will be the 5th straight quarter of negative growth and the first time we've seen that type since the period between the third quarter of 2008 and the third quarter of 2009. The question is, do weak profits automatically mean an economic recession is coming? No, but it's definitely something that we and other strategists are watching. Now, let's also keep in mind that these are the overall numbers for the entire S&P 500. Each company has its own struggles and triumphs. There have been plenty of sector and stock success stories over the last few years, and we expect to see more this year. According to one analyst, 4 S&P 500 sectors are projected to have positive earnings growth in the second quarter. And we're going to know more once earnings season wraps up. Probably the biggest indicator we look for with respect to the economy is gross domestic product. This chart shows in dark blue actual GDP growth in recent quarters. In light blue stripes, it shows GDP forecasts for the rest of the year. Data are from a group of over 60 economists surveyed by a Wall Street Journal every month. We can see that GDP growth tanked in the first quarter of 2016. The economy did the same thing in the first quarter of 2014 as well. At that time, the economy actually shrank 0.9%. GDP growth also took a hit back in the first quarter of last year, growing just 0.6%. However, we can see that for the whole of 2015, the economy actually still grew at a pretty respectable 2.4%. Clearly, the economy struggles in the first quarter of the year. This year, the picture is complicated by a number of competing economic factors that we're going to show you in the next few slides. Despite that, economists are still projecting solid growth for the rest of this year. However, most of the same economists polled by the Wall Street Journal believe that there's significant downside to their forecasts. The chart to the right shows whether these economists think they could be wrong to the upside, meaning they're too pessimistic, neutral, or wrong to the downside. And over 3/4 think the risk is to the downside. That is to say, if they're wrong about economic growth, they're likely to be too optimistic. So, it's clear that professional economists see some of the same headwinds we do. Is the labor market slowing down? It might be. There is good news though. Since the economic recovery started, we've gained well more than 8.8 million jobs lost. Including the June jobs gains, we've gained nearly 15 million jobs. And as of June, the headline unemployment rate stands at just 4.9%. And that's actually great news because the labor market is a big supporter of economic growth. However, there are some signs that job gains might be slowing. May jobs numbers were well below expectations, and the rate of annual job gains has slowed. And that could be to be expected. Given how far along the economic recovery is, one thing you might have heard experts talk about is the labor force participation rate, which is simply the percentage of the total population that is either working or actively looking for work. And you can see on the chart to the right that this line has been decreasing from its peak in 2007. The colored areas represent categories of people who have dropped out of the labor force. Many have aged out of the labor force and retired. Others have dropped out due to cyclical factors, such as a lack of job opportunities. The group labeled Other. They might have been affected by more permanent structural changes to the economy. These might be people who worked in industries that have undergone shakeups or no longer have the same opportunities. Many of these people might also be taking on contract or part-time work that isn't actually counted accurately. Being able to accurately measure why people aren't working is important to policy. It's also important to employers who might be struggling to find qualified employees. Overall, it's clear the labor market still has strength, but there might be limits to how much lower the unemployment rate gets because of these structural shifts in our economy. One positive indicator that's been supporting economic growth this year is consumer spending. Consumer spending is a critical part of the U.S. economy. Domestic spending accounts for about 70% of economic growth in this country. We like to look at multiple indicators to tell us how Americans are spending. One of the ways is we gauge how Americans are spending by taking a look at their discretionary spending on big ticket items, such as cars. Look at the chart on the left. We see that the light vehicle sales have been on a tear since 2009. The historical average is 15.5 million vehicle purchases per year, and as of June, we're at an annual rate of 16.6 million. But the numbers are down slightly from a peak in last fall of 2015. So what does this information tell us? Americans are still making major purchases, and that's great news for the economy. Another gauge of consumer spending is personal consumption. This measures how much U.S. households spend on goods and services each month. The chart on the right shows us the change in personal consumption from a year ago since May 2006. It's been adjusted for inflation. We can see that spending dipped into the negative during the last recession, indicated in gray on the chart. Since the recession ended, spending grew rapidly, expanding and then contracting over the last few years. In May of this year, which was the last month of available data, spending was up 2.7% from May of 2015. Personal income is also up. Since the first quarter of 2013, disposable personal income after inflation has been on a steady upward trajectory. Both of these trends support continued economic growth. So, let's summarize what we've told you so far about a potential recession. Predicting a recession is hard, and we won't have an official ruling on it until months after the fact. On the negative side, the economic expansion is getting a little old. The Federal Reserve is raising interest rates, and corporate profits are weak. These trends could push us toward a recession. On the flip side, GDP growth is actually moderate and still forecast to remain so. The labor market is strong, but it might be slowing. We also have consumer spending and consumer sentiment that remain strong. These trends support continued economic growth. All told, there are definitely some economic headwinds, and experts don't believe we're out of serious risk of a recession within the next year. This chart shows the result of a poll of Wall Street economists over the last 9 months. And as you can see, economists are more worried about a recession than they were in October of last year. On average, they put the odds of us seeing a recession at 21% in the next 12 months. However, economists have laid odds on a recession before. Back in January of 2012, almost 3.5 years ago, recession odds were the same with the same survey stood at 19%. And there has not been a recession since. We will continue to monitor all these factors we discussed here, and we're going to keep you informed, as we usually do. So, we reviewed the first half of the year, shared some of the indicators we're watching for this year, and talked about the probability of a recession. Now, let's close by talking about some of the strategies for dealing with volatility and down markets. The most important strategy of all, ignore media headlines. Here are a few of the headlines we pulled from the last 6 months. Now, as you can see, they're pretty dramatic. How can you keep your cool when you read this information in the morning paper? There's always going to be headlines telling you to panic. And what we're saying, ignore most of it. News outlets need headlines to pull in viewers. One of the ways they do that is by turning minor events into breaking news panics. This chart shows S&P 500 price performance between 2004 and 2014. It also shows CNBC viewership over the same period. Do you see a correlation? I know I do. Notice how viewership spiked as the stock market fell during the financial crisis. It wasn't because they were telling everyone to stay calm and carry on. People tend to focus on negative information and turn to the media in times of crisis. And this is not a great way to stay cool. Don't listen to the talking heads. Tune out the noise. Let us filter through the headlines and keep you informed. This chart shows the hypothetical growth of a $100,000 investment between 1996 and the end of 2015. It also shows many of the emotions an investor might feel along the way. It includes euphoria when markets are high, and surprise, nervousness, panic, and eventually defeat when markets pull back. It's all normal and part of being an equity investor. The investor who remained invested in this hypothetical illustration might have seen that investment grow to nearly $500,000. Investors who sold out during the lows, they would have missed out on most of the rallies that followed. Keep in mind that this is a hypothetical illustration and doesn't include factors such as taxes and fees. It's not meant to show you performance of any actual investment, but give you a sense of what happens with the peaks and valleys of the market. The central tenet of investing is we are consistently balancing risk against return. The higher return we seek, the more risk we have to be willing to accept. One of the most important things you need to do as an intelligent investor is to understand your personal attitude about risk. Risk is, unfortunately, not something we can completely do away with. Though we mostly talk about market risk, the risk that an investment will lose value due to market factors, there's also other kinds of risks that affect investors. Longevity risk, inflation risk, currency risk, interest rate risk, credit risk, and I could keep going. As your professional, it's my job to help you understand how these risks affect your financial picture and help you develop in-depth understanding of your personal comfort level with risk. For this reason, whenever we build portfolios for our clients, we always do so with in-depth risk assessments of them. If recent market gyrations are making you nervous, it might be time to come in and talk about your portfolio. While we don't advocate making major strategy changes due to normal volatility, we do take into consideration your greater comfort and increased peace of mind. You would never put all of your money into one single investment. One of the reasons is because of time horizon. Along with your risk profile, we need to understand when you expect or need the money you're investing. 3 years from now, 10 years, 20 years, by understanding how and when you'll be using your savings, we can make sure that you have the money you need when you need it. Though we can't predict what markets are going to do, we can create strategies to help mitigate the effects of volatility and market swings on your overall picture. The money you'll need in the next 1 to 3 years, we want to keep in investments that are more highly liquid and much more stable in value. The longer your time horizon, the more prudent risk we can take with your portfolio. We might include more equity exposure in some or alternative investments. While you might say to yourself that you don't want to take any risks, even with long-term money, there's always one risk you can't outrun: inflation. Now, can you really afford to let your money sit there with inflation eating away at it each year? Though inflation has been low in recent years, historically, inflation averages around 3% a year. With Americans living longer than ever, it's important to have enough growth potential to be able to fight rising costs for 20 and sometimes even 30 years. Our goal with this strategy is to identify short-term, medium, and long-term needs. We then spread your money along different investments with prudent amounts of risk and liquidity. In this way, we strive to ensure you are properly diversified. Once your portfolio has been constructed, that doesn't mean your hard work is over. We continually monitor markets, performance, and current trends to stay on top of what's going on. While we believe it's prudent to have a core of passive investment selections that are allocated for long-term growth, we also know that just because something is a good investment today doesn't mean will be a good investment tomorrow. That is why we choose to engage in the human element. That comes in the form of a single strategist or team of portfolio strategists making investment decisions. Active strategists rely on analytical research, forecasts, and their own judgment and experience when making investment decisions about securities: when to buy, when to hold, when to sell. Now, an active strategist cannot eliminate the risk of fluctuating prices and uncertain returns. It also cannot ensure profit or guarantee against loss, but it simply helps be responsive to changing market environments. I want to close with this. There's a lot of financial and economic uncertainties in the world, and while we often can't predict them, we can mitigate them by preparing in advance. Here are some of the top fears cited by retirees in a recent survey. 44% worry about future healthcare expenses. 44% worry about reductions in Social Security. 41% worry about outliving their savings and investments. How prepared are retirees for retirement? It's normal to be worried about the future. It's normal to wonder what retiring in volatile markets will be like. And it's our job to help give you some confidence. Thank you for your attention today. I appreciate your time, and I hope you enjoyed the presentation. This is Chad Stayskull with Eagle Wealth Management, signing off.